The hidden turning point nobody reported. It didn't make headlines. It didn't trigger alerts. It didn't even register as an event at the time. Yet this quiet moment marked the exact point where the market's direction changed, long before anyone realized it had. To understand why this mattered, we need to revisit a period when markets appeared stable, even confident. Prices held. Volatility behaved. Commentators spoke of resilience. From the outside, everything looked intact. But beneath that surface, a subtle shift was already underway. This story matters now because the most important moments in markets are often invisible. They don't announce themselves with drama. They pass quietly, disguised as routine behavior. And by the time they're recognized, the consequences are already locked in. The first reveal begins with positioning data that seemed unremarkable. Large investors weren't selling aggressively. They weren't buying either. Exposure stayed roughly the same, but the way it was held changed. Time horizons shortened. Flexibility increased. Commitment softened without disappearing. The second reveal emerged in execution behavior. Trades became more fragmented. Size was broken down. Orders were spread across time. This wasn't fear-driven activity. It was caution expressed through patience, a subtle signal that participants were no longer willing to be first. The third reveal came when traditional indicators failed to react. Volatility stayed low. Risk metrics remained calm. Headlines stayed optimistic. The turning point didn't show up in prices because it wasn't about price. It was about intent. And intent had already begun to move. That unreported shift, quiet, rational, and easily ignored, was a moment the market stopped being supported by conviction and started being supported by habit. Everything that followed traced back to that point, even if no one noticed it when it happened. As intent shifted, the market surface stayed calm enough to reassure anyone not looking closely. Prices drifted within familiar ranges. Volatility remained muted. Economic data offered no clear warning. To most observers, the environment felt stable, even predictable. But stability built on habit behaves very differently from stability built on conviction. The conflict began with how quickly support vanished during small tests. Minor dips no longer tracked decisive buying. They paused, hovered, then recovered slowly. Not enough to alarm anyone, but enough to suggest reluctance. Buyers were still present, but they were no longer eager. They waited for confirmation instead of creating it. Institutional desks felt the change first. They noticed that defending levels required more effort than before. Liquidity appeared thinner at moments that used to feel automatic. Market makers adjusted quietly, widening spreads just enough to protect themselves. None of this showed up in headlines, but it changed the market's internal rhythm. The tension deepened when derivatives reflected the same shift. Hedging costs crept higher, skew adjusted subtly. Traders positioned for uncertainty, without betting on collapse. It was a market preparing for surprise rather than direction. That distinction mattered. The turning point remained invisible because nothing dramatic followed immediately. No sell-off, no rally, just a growing sense that the market no longer wanted to commit. Confidence didn't disappear, it diluted, and diluted confidence spreads silently. Analysts searching for signals looked in the wrong places. They focused on volatility spikes that never came, on macro triggers that didn't materialize. Meanwhile, the real change unfolded in behavior. Capital stayed mobile. Exposure stayed flexible. Participation became conditional. The market had crossed a threshold without realizing it. It was no longer supported by belief in continuation. It was supported by inertia. And inertia holds only as long as nothing forces a decision. As days passed, that unreported turning point grew more powerful. Each calm session reinforced the illusion that nothing had changed. But each calm session also allowed conviction to drain further, unnoticed and unmeasured. By the time the market faced its next meaningful choice, the foundation beneath it would already be different. The turning point wasn't ahead. It had already happened, and the market was moving forward without realizing it had left something essential behind. The consequences of that hidden turning point began to surface gradually, almost politely. Nothing broke. Nothing collapsed. Instead, the market started behaving in ways that felt slightly unfamiliar. Even to seasoned participants, movements became slower, reactions felt delayed, outcomes seemed less decisive. It wasn't volatility that changed first, it was follow-through. The conflict intensified as this new behavior repeated itself. Each small shock revealed the same pattern. Prices would move, pause, then hesitate. Buyers waited longer. Sellers tested depth cautiously. Levels that once acted as firm support now functioned more like suggestions. They held until they didn't. And when they failed, the recovery was weaker than expected. Institutional investors noticed a shift in their internal data. Execution quality declined marginally, but persistently. Orders that once cleared smoothly now required patience. Slippage increased in places that had historically been reliable. None of these issues were severe enough to demand action on their own. Together, they formed a signal too quiet a headline, but too consistent to ignore. The buildup accelerated as positioning data confirmed what behavior suggested. Exposure wasn't collapsing. It was becoming conditional. Large players stayed invested, but with shorter horizons and faster exit plans. Capital was ready to move at the first sign of stress. Commitment existed, but it was fragile. Derivatives markets echoed the same story. Protection became slightly more expensive, even without visible fear. Skew adjusted not for disaster, but for surprise. Traders weren't bracing for a crash. They were bracing for uncertainty. That distinction mattered. It meant the market no longer trusted its own stability. The turning point's true power lay in how invisible it remained. Because nothing dramatic followed immediately, confidence in the old narrative persisted. Commentators spoke of consolidation, of healthy digestion after gains, of strength through calm. Few recognize that calm can also be a symptom of exhaustion. The tension reached a new level when the market faced a more meaningful test. Not catastrophic, just demanding enough to require conviction. This time, the response was telling. Support arrived late. Participation was uneven. Liquidity appeared selectively, then vanished. The system didn't break, but it strained audibly. At that moment, the unreported turning point became unavoidable for those paying attention. The market had lost its reflexive confidence. It no longer assumed continuation. It required proof. And proof in markets is expensive. The realization spread quietly through professional circles. Something fundamental had shifted weeks ago unnoticed. The market was no longer driven by belief and momentum, but by fear of being last. That change doesn't show up in indicators. It shows up in hesitation. And hesitation, once embedded, changes everything. Because markets don't turn when everyone decides at once. They turn when conviction drains quietly, session by session, until the next decision finally exposes what has already been lost. The hidden turning point was a moment of action. It was a moment of withdrawal. And by the time the market was forced to choose again, it was already standing on a different foundation entirely. The hidden